Hello everyone, my name is Matthew Frailey with BreakpointTrades.com. We've been bringing you advanced technical analysis, market commentary, trade ideas, and mechanical systems like you see here for our SPY systems and ES systems since 2003 for individual traders and professional institutions which I consult with on a weekly basis. Anyway, it's been a while since I've done a YouTube video. I've been concentrating my updates for our subscribers posted to our website. But anyway, markets had quite a negative year. As you know, I've been calling this a bear market since at least December of last year and January, and that has played out. So let's go ahead and jump to our newsletter. This is our newsletter recording section, as you can see here. Anyway, this is the newsletter for Monday, May 9th, 2022. This is the table of contents. We're going to discuss the general market. Before we get that, we're going to make some comments about the SPY and ES systems, which still remain in cash. There's 40 subsystems for SPY and ES, which I send out trade notifications to our subscribers for. And they've done a good job about staying in cash. In fact, one of them went long last week on Monday, exited perfectly on Wednesday. And one or two of these might be close to going long anytime here because of the washout in the market. Again, we're going to look at the major indexes. We'll look at some indicators, bonds, 10-year treasury yield, a few sectors, cryptocurrencies, which got hammered on the weekend. That's how one reason I knew the market was going to have a bloody Monday, because crypto started selling off on Saturday and, of course, Sunday. We'll follow up with commodities, U.S. dollar, precious metals. We're also going to look at the yen. All right. But as far as the market, essentially there was nowhere to hide today. It was a 90-90 down day. All right. Big boys have been liquidating. In fact, today was the biggest sell-off day for fifth biggest sell-off for retail investors on the QDS records going back to 2016. All right. So again, 90-90 down day. So selling was across the board from the major indexes, which lost 2% on the low end. That's for the Dow, 4.3% for the NASDAQ area. Every major sector we follow was down, with energy taking the brunt of it. That area, in fact, to me, has more to fall because it just started from the lower. It has the most room to fall because it has not been selling off like everything else. All right. Commodities got hammered. Everything from energy to agriculture to metals, precious metals. Nothing was spared. Okay. As far as the market, using the S&P as our proxy, in fact, it exceeded one of our initial targets, which was the gap from 40.20 from April 2021. And our next target was essentially a hit right around that 39.75 area. There's a little gap, and I have a lower gap right around 3,900. I do believe we're getting closer to some sort of short-term trade washout low. And CPI, PPI, that's inflation data, is reported on Tuesday and Wednesday, respectively. Moving on, just looking at some of the headlines here. Here's an image I took from Drudge Report. So you can see at the top, headlines are all about stocks. Netflix down 71% for the year, Snap 50%. Amazon, 47%, Tesla, Google, Bitcoin battered, blah, blah, blah. The reason I show this is because a lot of times you start seeing these major headlines closer to some sort of at least trade low. Again, don't get me wrong, guys, especially if you're new to Breakpoint Trades or our videos. We think we're in the midst of a deep bear market that's going to last for quite a while. We're still in early inning stages. And Steve and I hope that that's all it is a bear market. We hope there's not some other, major financial collapse of the system or deflation eventually, some real unwinding of things. That's our biggest concern, which I talked about on the weekend. But regardless, we're in a heck of a bear market here. I think it's got a long way to go, but short term, probably getting close to some sort of initial trade low. All right. Again, that's when you start seeing headlines like this. And retail investors are starting to dump. Next. Now, image number 3. This shows you our trades are long subsystems for SPY. We have this for SPY and ES. Again, none of these are in any long trades at this point. They've all safely in cash. Last week on Monday, we did have the CCI take a nice quick long here and exited for a nice winning trade. The CCI system has 95% winning trades, profit factor of 70. The way these reversion to mean systems work, guys, statistic-wise, they generally win about 9 out of 10 trades, and they're very hard to trigger, okay? So some of these are getting close to triggering some buy signals. They're not trend following, they're reversion to mean, which means when you get very oversold, they look to take some entries and then they exit, all right? But it's interesting that none of these systems have, they've been buying this dip. They've been waiting. And so they've done a good job here of not taking any drawdown during this major decline. But it's possible we could be close to one of these systems doing a trigger. My guess would be the bear long, which it's a type of a long trade that occurs in bear markets, logically named. So I have 12 systems that look for long trades on the SPY. We also have 12 systems that look for trades on the ES futures. We also have the same set of trades that look for shorts. Next. All right, moving on to the index sector table. You can see what transpired today. Look at the bloody red here. So the major index is down anywhere from 2% on the low end. That's the Dow. Remember, those stocks make money. It's stocks that have balance sheets that are being, taking the least brunt. It's those high flying growth stocks, that huge PE ratios or no PE ratios have been taking the brunt of the selling since November of last year. You can see the NASDAQ down 4.3%. Russell 2000 down 4.2%. S&P down 3.2% today. Again, those are big numbers for a week, and that was today. As far as the major market sectors here, bloody red, we follow 21 sectors. Every single one of them were down. And what took the brunt was the energy sector. Those sectors have been doing the best. But, when you have this type of sell-off in the market, eventually everything gets sold. People need to raise cash, margin, calls, etc. So everything eventually gets taken out, and this has probably the furthest to pull back, quite honestly, just because it hasn't been selling off. So today 10% down for oil services, 8.3% for the XLE. Those are big numbers. Currencies, US dollar was slightly up today. It's been very strong, as you know. It's had a heck of a rally, and it's up near that 104 area, which is a resistance. Cryptocurrencies, you can see huge losses here, double digits on a lot of these. They started selling off on the weekend on Saturday, and of course Sunday, and then that's why I knew the market was in trouble. Think of the cryptocurrencies as kind of like a leveraged NASDAQ, all right? And also they tend to lead. So the fact that they were leading down was a warning sign for today. Commodities, all bloody red. Only thing positive here, palladium, which I doubt any of you are trading. But everything down. You can see natural gas down 12.6%. What a reversal. Crude oil down 6%. All the ags, metals, precious metals got hit. And, of course, especially the gold stocks down almost 6% for GDX. Very ugly. Bonds, high yield corporate was down. TLT was up. Now, over the weekend in my newsletter, I was looking for a trade low on TLT, and we may have gotten that today. I'll have some charts here tonight. In fact, I went long some of this ETF because I think this area will likely put in a trade low first. Maybe that'll soon correspond with a little washout low in the market. You can see rates were down today. Next. Item number 5 shows the economic news calendar for this week. Again, CPI, PPI are the two big items in the next couple days, inflation data. And let's go and jump to these index charts, folks. So, first chart below, item number 6, is a daily snapshot of the 5 key major indexes, the Dow, S&P at the top, IWM small caps at the bottom, NASDAQ in the middle here. So you can see a lot of these closed below the lower Bollinger Bands. Again, big sell-offs this year from the early January highs or late December highs, whichever you look at it. We are in a bear market. That has been our theme since December, early January. Next. Chart number 7. I showed this chart on the weekend, but I went and updated it. This shows you the annual chart for these indexes. So far, the Dow down 11.3%. Again, it's holding the best because you have companies that actually make money there, have good balance sheets. They're getting punished the least. And again, in a bear market, everything gets punished eventually. S&P 500 down 16.3%. NASDAQ down almost 26%. Small caps down 21.2%. DBC, that's commodities, was up 36% for the week. It's now up 30%. Again, it lost about 6% today. And TLT is down about 22%, which is not showing up on here. Next. Let's go ahead and move to the index charts. We'll start with our proxy, the S&P 500. So here's the daily S&P. As you know, we formed this divergent high back in December of last year. And Steve and I were talking about the negative breath, all those warning signs that were showing up last November. We had huge negative breath, all these stocks selling off precipitously, stocks getting taken out to the woodshed under the surface. It was like a cancer, but it was being masked by the indexes, which rallied in December, despite all that carnage underneath. So you had negative breath. It was showing up in all these charts and indicators of ours, and that was a big warning, and that ended up ending that bull market. So overall, you can see how this bear market has occurred. We had that trade low in late January, lower high. We had another low in February. Decent rally up to the March area, which stalled right around the 61.8% fib. It was a good shorting opportunity. And overall on this decline since the late March highs, we've been looking for at least an initial target to fill this open gap at 40.20 to 40.34. So that was our short-term target. That was filled today. And our next target was basically filled from back here as well. This could be another target, this demand zone right down in here. I do believe we're getting close to some sort of trade low here. Then we'll get some sort of retracement bounce. But again, realize the longer term, we're in a bear market. Again, we are getting some divergences in some of these indicators now. Next. Chart number 9, here's another daily chart. This also has the volume on the side. I've been showing this channel. You can see how we worked our way down to this initial target. We also have a thin zone here, which when you have a thin zone, that allowed price to simply melt down into it, which is what happened today. Bigger volume down in these areas, so these are offer some little more support down in here. Next. Chart number 10, here's a weekly view. Again, it's only Monday, but just showing the weekly. So way back in here, early part of the year, we had a symmetry break on the weekly chart. That led to a lower high. And you can see the move on average ribbon guide. Oh, it's a great guide. It flipped to a bearish configuration back here and then pinched on the underside here, which allowed a shorting opportunity, lower high. This gives you a little short-term symmetry target, which we're basically nearing. This here is a target based on this. Next. Chart 11, here's a monthly view of the S&P. And we've been discussing this chart all year long, so this shows an end to that bull market at the early part of January as a completed fifth wave move, essentially a 12-year bull market. Again, some folks consider, like CNBC, they'd consider this a bear market. This 30% decline we had in the February, March 2020 timeframe. But to me, I don't consider that a bear market. Bear markets are about time. They need to last long enough to create negativity, bearish extremes in the public, and a change in leadership, stock leadership. And this, essentially 1 month correction was not long enough for a bear market. It was deep. It was 30%, but it was a sharp correction in a ongoing bull market, all right, which started in March 2009. And essentially what happened is we had a blow off top here. So you can see the overall slope here. The big correction there in the February, March 2020, and then just rocketed forward. And that led to that blow off high. You can see the RSI divergence, etc. So we're now correcting in a bear market. Usually bear markets will retrace some sort of fib relationship to the previous bull market. So drawing the fibs back to the 2009 lows, you're looking at a minimum of, say, the 38% fib down here in the low 3200s. Over the weekend, in my weekend newsletter, I showed all these past bear markets going back to 1929 and showed various relationships. And at minimum, all the bear markets in the past retraced 38% of the previous bull markets. Okay. So that would be my minimum. Over time, I'm not expecting, guys, for the S&P to go straight down here now and be done, right? I'm expecting for, probably some sort of low sometime soon, rally, lower high, down again, okay? My thing is, though, that because of the unprecedented Fed, all this debt, that this bear market may need overall deeper prices to eventually come to conclusion. And maybe it needs to last a couple of years. All right. That's something that a lot of new investors that I see on YouTube, over the last few years, I've seen all these YouTube channels. A lot of young kids look like they're in their early 20s. I was in college then. I don't know how they had money to trade, but they know it all. They've figured it out. Well, I think what we're going to see over the next couple of years is all that get washed out. All right, because there's a lot of people, guys, that have not been through a true bear market. This back here, February, March 2020, was not a bear market. It was a sharp correction that if you closed your eyes, if you weren't over leveraged on margin, you could have just closed your eyes, came back in a month, and everything would have been fine. Okay. This bear market is going to take quite a bit of time, going to destroy a lot of stocks, and it's going to destroy the buy the dip crowd, which it already has, and it's going to wear people out if this lasts, a couple of years and is quite deep. Anyway, this channel here, logically, one target could be this lower channel line. I think there's perhaps eventual possibility we could even make it to the lower 2000 area down into here, which I'll discuss in a moment. So let's move on. Chart number 12, here's another monthly view of the S&P. Now this is a linear chart. You need to draw it as a log to draw a trend line. But I'm showing this because you can see because what it really shows is how we ended that final part of the bull market in this parabolic fashion. Look at the slope difference between the start of the bull market way back here. And then once you had this correction, the slope just notice the slope difference, how much more the higher slope it was here. Classic blow off top that we've had. Okay. Anyway, we ended this high here with a negative divergence. Moving average ribbon hasn't quite flipped yet. It does lag, but eventually we're going to see that flip. These are some of my longer term targets, these demand zones. All right. This demand zone, it's an area of support. It comes in right around the 61.8% fib retracement from the March 2020 low to the January highs. Okay. To me, that's minimum target of this bear market over time. But to me, given the backdrop of everything, you know, just the market retracing only back to the late 2020 area, to me, doesn't seem like it would be enough. I think over time we may need to even work down to this area, down into here. Again, for this to occur, guys, I think it would probably take a good year and a half. This isn't going to happen this year. All right, down into this range. Okay. But overall, this year, we're going to see likely prices down into this point. I don't think we're going to go straight down to here, though, first. As I stated, likely get some sort of bounce here soon, and then eventually get down into this range, you know. Then maybe something like this. Just making some guesses on how this bear market could ultimately unfold. Okay. By the time this bear market unfolds and ends, the general public is not going to be interested in stocks. There's going to be a whole new leadership change. What was hot during the bull market back here is not going to be hot here. It's going to be a whole new, group of leaders. One of the issues that investors have during bear markets is they keep trying to chase previous leaders of bull markets. They keep looking for those entries on Tesla and Apple, stuff like that. But when in reality, they should be looking for the new leadership. Again, that's a long way off, guys. I'm just making some, general comments about what I think will eventually unfold. Short term, I am looking for a short-term trade low here any day. All right. Next. Moving on to the shorter term intraday charts. So chart number 13, here's a 2-hour view. Again, you can see this vicious sell-off here. Short term, that rally last week looks like it was some sort of wave 4, and we're working on some sort of wave 5 here. To me, maybe this is a little wave 3, get a little wave 4 bounce here, and then one more little low, and maybe that'll finally put in a trade low. Again, this washout trade low can occur anytime. All right. Next. Chart number 14, here's the 60-minute view. Again, just continue to stair step down. Any divergence on this time frame? Not really. Next. Chart number 15, here's a 5-minute view. Just shows you the action the last few days. And you can see today, your strategy would have been shorting the VWAP reversals. The VWAP is here in the cyan line. This is also a pretty useful indicator, this NYUD with the 15 EMA. It made absolutely no attempts at crossing over the moving average today on these little bounce attempts. Next. Chart number 16, here's a 3-minute view. So again, we had an initial sell-off this morning. We had some positive divergence on the MACD. So you got a little trade opportunity long here if you're a day trader. Could have got a bounce here. It was essentially an ABC bounce in the downtrend. It was a short opportunity. And sold off, rallied back to the VWAP here, stalled there again, yet another shorting opportunity, and sold off. Here's that same NYUD indicator. Again, made no attempts at going positive on those rallies. Next. Chart number 17, here's a daily chart of the S&P. This is our KISS trend system. As expected, it's been in cash. The KISS trend systems did well during the bull market, and as I've been stating, during a bear market, they're going to be in cash most of the time. And when they do go long, it could be times like this where it takes a long, it gets out for a whipsaw or just a very small winning trade, and then it gets out. The DVTs are the stops. So it tried a long back here, it got out quickly, and been down from here. Some of the indicators here, the moving average ribbons, they went bearishly stacked back here. When it pinches up under the underside here, those are a bearish pinch. Those are short opportunities like here. And even last week on that Wednesday rally, squeezed on the underside was a short opportunity. Next. Chart number 18, here's the cycles, here's the daily chart, here's the half day. Last week we stalled at the ATR. The ATR is resistance in all these time frames. Short term, 2-hour, 60-minute, we have to mark 9, so we are getting quite oversold here. Next. Chart number 19, triple Qs, down, 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 down to this area here, and Again, we'll just see where this sucker bounces. On the weekend, I showed a weekly chart, which I'm not showing here tonight. Next. Chart number 20, here's a 60-minute chart. We do have a potential wedge you could draw here. The problem with the wedge, you don't have any MACD divergence. True wedges usually have MACD divergence, so this could easily just be blown out if we open negative tomorrow. But it is an aggressive wedge to watch for potential bounce. Next. Chart number 21, here's the daily kiss for the triple Qs. Again, it's done a very good job this staying out of this market. It was long last year. You can see DVTs were hit way back in late November. It didn't get back in. It tried to go back long here in March, early March, had 3 DVTs. Those are trailing stops. Got out, and it's been in cash since. Next. Chart number 22, here's the cycles. Similar look to the S&P cycles. Very short term, 2 hour, 60-minute. Guessing to mark 9s here. Next. Chart number 23, IWM small caps. After that ABC rally into resistance in March, has been down ever since with bear flags. Again, it's getting quite oversold here, but I don't see any triggers to the long side. But it is getting quite oversold. All right, let's move on. Look at some indicators. Chart number 24, here's the VIX. VIX was up today. Again, the VIX is moving up with the market, but it's not having these huge spikes into the 50s or anything. Do we need to see a washout like that? Or is it just going to end up in here like it did in some of these past attempts? We'll see. But we're not seeing any big spike nature on the VIX. Next. Chart number 25, here's the VVIX. That's the derivative of the VIX. And boy, this has been one hell of a great indicator. So, as the rules state here, whenever it's below 110 and crosses above 110, that gives you a reliable caution signal or a short signal. And look how well these have worked. Okay. In fact, you've had 4 short signals since late March. All of these, even the one last week on Thursday, was one hell of a short. I know it's scary taking a short on a big down candle like that, but it would have worked. Okay. You can see the short signal back here right at the highs. All these short signals, they're not always perfect, but they're pretty damn good. This has been one hell of an indicator. We provide this as a chart URL to our subscribers, so you can simply follow along on your own. Next. Chart number 26, here's the NASDAQ with these breadth indicators, the 52-week highs or 52-week lows, and the difference between the 52-week highs and lows at the top. You can see the start of the bear market here. And one thing I talked about in December of last year was that, and November, was that during bear markets, this difference between the highs and lows would go negative like this. And if you're in a bear market, it would simply stay negative. And that's what's happened. So that ended up playing out. In fact, every time it gets near zero, or even maybe goes slightly above, these all gave you fantastic short opportunities. Okay. Right back here in late March, I picked the high. Even this was close to zero. That was a good short. So going forward in the bear market, guys, use this indicator. Now it's quite oversold, so probably getting close to a washout buy signal, but eventually when it trades back near zero, will be yet again another short opportunity. Now, what I want to show is short term, the difference here is really spiking, kind of like it did last January when it spiked at the lows here. So we're probably getting close to some sort of washout here. You could also see it on the new lows at the bottom, spiking way outside the Bollinger Bands. Those can correspond with some trade lows. Next. Chart number 27, here's the S&P with a variety of indicators. The VIX, the VVIX with Bollinger Bands, and some of these breadth indicators. CPC. This hasn't updated yet. The CPC is over 130 today, so that's quite bearishness is getting a little extreme here short term. The breadth indicators all spiked down today. Look at the NYHL way down here below the lower Bollinger Bands. Next. Chart 28, here's an indicator showing the percentage of stocks in the S&P 500 that are above their 50-day moving averages. Quite interestingly, despite this big sell-off in the market, still 104 stocks in the S&P are above their 50-day moving average. Now, part of that is because we've been declining for a while. But, look at some of these past areas where this indicator really spikes, where the number of stocks in the S&P get down here, in the 20, 30, 40 area, 50 area. What kind of sell-off is it going to take to get this indicator down into here? Boy, oh boy. This is concerning that we still may need, another day of drubbing or two before we get this indicator down into the more oversold areas. Next. Moving on to market sectors. I'm not going to cover all the sectors this evening. Again, everything was down today, like I said. The one area that's been strong, the energy, really took it on the chin today. I think that has potential to sell off probably the most. And we'll take a look at some individual sectors here. Chart 30, here's XLE Energy. So XLE Energy had a high in April, this rising wedge, RSI divergence, MACD divergence. We were expecting a sell-off, which we got. Then I stated my preference was for some sort of wave B. It didn't form a lower high. It made a slight higher high, but technically that's still a wave B in my opinion. And now coming down on a wave C. So I think we could easily see energy come down into this range, maybe even down to the 200-day moving average. So my point is this area, to me, is most prone for a bigger sell-off since it's just started after a lower high. If you're looking for a short follow-through, even if the general market puts in a trade low, this area could continue to weaken. Next. Chart 31, oil services. Now, it technically formed a lower high, unlike XLE, which made a higher high. Look at that dump today. Next. Chart 32, home builders. As you know, the interest rates, which are over 5% now, 5.25% for a 30-year mortgage, that is really starting to tame the housing market a bit. Supply issues are still keeping the housing market okay, but eventually that is going to go away, and we're going to be looking at one hell of a crash in the housing market. All right, but you can see the XHB stalled at its 50-day moving average last week. It wasn't down too much today, only down 0.4%, so it's holding up quite well here. We have a little MACD divergence right now, so this could try to put in a low short term. Next, chart 33. Here's the real estate ETF. They actually got pummeled today, though, down 4.25%. Next, chart 34. Biotech down 8.2%. Now, this area has been downtrending since early 2021 and has been absolutely destroyed. Next, chart 35. Here's the monthly view. Here's an 11-year trend line, which was broken. It's now trading down at levels from 2016 and 17. Again, look at this sucker. It was 170, almost 175 bucks back in early 2021. It's now at 64. These are your next support areas. Let's move on to bonds. Chart 36, J&K, high yield corporate. That tends to move the market, has been selling down and leading down. Next. Chart 37, TLT 20-year bonds. I discussed this on the weekend. It has been selling off this year. They're down 20% for the year. And this has hurt a lot of managed portfolios where these investment advisors like A.G. Edwards, which to me are about the worst of them, they do buy and hold. They don't get their clients out of the market. Their hope is that during market declines, bonds will help make up some of the losses in the indexes. Well, this year has been the opposite. Both indexes and bonds have sold off. So, if you're in one of those managed portfolios where they just keep you in everything and they have you in the indexes and bonds, you're likely really taking it on the chin this year. But anyway, what I talked about on the weekend was that the sell-off short term is getting a bit parabolic, and I'm looking for a trade low here. And you can see it was up today. We have some divergence developing on the RSI and the MACD. So again, this straight down move parabolic move is unsustainable. So I am looking for a reversion to mean ABC rally up eventually. Next, Chart 38, UBT. Here's a leveraged ETF. I bought a little bit of this today. Got a tight stop at the lows. Next, Chart 39, TLT 20-year bonds. Again, hell of a sell-off the last couple of years. Next, Chart 40, here's the monthly chart. Showing this because based on symmetry, we are nearing kind of a symmetry target down in this range where we'll probably see TLT start to have some sort of trade low. Not the low, but a trade low. Next, Chart 41, here's 10-year treasury yield, daily chart. Talked about this on the weekend. As you know, rates have been going up. 30-year treasury is up around 5.25% now if you're trying to buy a house. But I am looking for a short-term top in the 10-year treasury yield. You can see the MACD divergence forming here. So once this starts pulling back, if it does, that could correspond with a trade low in the market in the short term. Next, Chart 42, there's the weekly view. It's up near some resistance back here, so a logical area to maybe at least pause. Next, Chart 43, here's the 10-year treasury yield monthly chart going back to the early 80s. Again, we broke this 30-plus year trend line. The era of low interest rates is over, the bear market of interest rates. So long term, we're going to see much higher interest rates. But we have some resistance right in here now. These are your next long-term resistance, which I think we'll eventually make it up to. But it's not going to be a straight up move. So maybe we get a little pullback here in the short term. Maybe that'll correspond with some sort of bounce in the market. But ultimately, I'm looking for much higher interest rates over time. Okay. Next. Moving on to commodities. Chart 44, DBC, commodity ETF, formed this rising wedge. So big reversal today, wasn't it? We've had this divergence forming, RSI, MACD, and it still hasn't broken this, so it could still try to hold this. But should it break down here, now the 50-day moving average is your first really big support. If you lose that, this would be a kind of a symmetry target. Next. Chart 45, crude oil, big reversal here. Next. Chart 46, natural gas, big reversal after that second push up last week where we formed divergence. Big reversal the last couple days. Next. Chart 47, oil, that's a way to trade it. See that divergent high that set up last week. Next. Chart 48, copper. Been selling off. This is also indicative of a slowing economy. Copper is one of the most utilized commodities. There is a little bit of divergence now forming now, short-term RSI. So we'll see if we can get a short-term trade low sometime soon. Last week it stalled at the 200-day moving average there. Next. Chart 49, DBA, agriculture, breaking down, not surprising. We lost the 50-day moving average last week. That was a negative. And this opens up the door for an eventual pullback down into this range. This would be a good buy opportunity if it gets down into here. Likely what would happen is the 200-day moving average would catch up to it. All right, moving on to cryptocurrencies. Chart 50, Bitcoin. Again, as I stated, this started selling off on the weekend. And look at the big sell-off today, down near 30,000 now. Remember, think of Bitcoin like a leveraged NASDAQ. It's not a safe haven. Next, Chart 51, Ethereum, likewise dumping. Next, Chart 52, Merrill, one of the cryptocurrency type stocks. And look at this carnage. We talked about this Christmas tree pattern last year. The sucker was $83.50 back there in November. I personally know a guy that, he bought this thing around the $5 range a couple years ago. Never took profits, and he still has it. So he's ridden it all down. He had an amazing buy on this thing. Didn't take profits. And the thing is now $12. Eventually, guys, you got to take profits on stocks. His reasoning for not taking profits was, well, I have all these gains. I'm going to have to pay taxes. Well, does that look smart now? giving up all those profits because you're worried about paying taxes. Next. Chart 53, US dollar. Slight update today. Again, it's had a heck of a run here. There is some divergence forming up here. It is near major resistance, which I'll show you in the next chart. Chart 54, there's the monthly chart. It's right around this 104 resistance, which is significant. It goes all the way back to 1999, 2002, 2017. It was an important area. So we're right here. So we'll see if the dollar pauses here. But the dollar's been super strong. That has not helped gold. Next. Moving on, chart 55, the Japanese yen. While we're tightening, and a lot of countries are, the Japanese are continuing down their same path of, money printing. And look at the effect here of the Japanese yen. Look at that sell-off from March. Wow. Next. Chart 56, weekly view of Japanese yen. Now, I will say it is getting, to me, quite oversold here. Forms a doji candlestick. You could probably get a reversion to mean bounce off of it. Next. Chart 57, here's a monthly view of the Japanese yen. Back near 2002 lows. Next. Chart 58, FXY, that's the Japanese yen ETF. That's a way to play it if you like catching falling knives. Like I said, it's probably eventually going to do for some sort of reversion to mean bounce back to the 9 EMA. You need a trigger. You need a tight stop if you attempt that. Next. Chart 59, here's the daily chart. So some divergence forming here in the MACD RSI, but you can see since March, the 9 EMA has been your resistance. You really need to get a close above the 9 EMA to end this initial downtrend. Next. Moving to precious metals, chart 60, gold cannot bounce to save its life. You can see the stocks are strongly leading to the downside. Ugly action, still above the 200-day moving average, but this sell-off in stocks via the ratio here is not pretty. Next, chart 61, silver, also a big sell-off here. Got some long-term support down here. Next, chart 62, GDX, again, down almost 6% today. Ugly action, closed right below the 200-day moving average. The stocks lead, guys, and that means the metal is likely to sell off further now. All right. Okay, let's take a look at just some stocks. I'm not going to throw trade ideas here just because of the volatility. Chart 63, ARK, Kathy's ARK Fund, new low today, down near $40 now. Next. Chart 64, ARK weekly view. We've had this target of ours down here at the March 2020 lows. We call this the demand zone. And lo and behold, we've gotten down to here. So Kathy has given all those gains up, kind of like a big Christmas tree. You can see the big move from that coil there. Would have been a great short opportunity up there. Next. Oh, by the way, on Kathy's ARK Fund, guys, by the time this bear market is eventually over, Kathy will be a footnote in history. All right. Kathy's an example of one of those that did a great job during the bull market, and they don't change their tune. Anyway, Apple, Crapple. Apple's down near the support area, demand zone. We'll see if we can get a bounce in here, but overall, Apple, I expect much lower prices over time in a bear market. It isn't going to be spared. Next. Chart 66, Amazon also been getting creamed. Now it is getting quite extended here. It's riding the lower Bollinger Bands. Moving average ribbons are super wide. RSIs are buried. So could be getting close to a reversion to mean bounce. Next. Chart 67, here's the weekly chart. So we get a bounce soon, fine, but longer term, I'm looking for prices eventually down in here, down in this range. But doubt we go down to here first. Maybe get a bounce some short term and then down to there. Next. Chart 68, Facebook, Meta. We showed this chart early this year. And this is longer term, could see Facebook down into this range during some sort of bear market. Next. Chapter 69, Netflix. It's been destroyed, honestly, during a deep bear market that lasts for, a good another year or more. Could we see Netflix eventually trade down to these levels over time? It would not surprise me. They don't expect it to go down to here in the short term, but over time, over the next year or two, under a deep bear market, definitely. Next. Chapter 70, Tesla, Elon. So, Tesla, we were looking for a lower high after this falling wedge, and we got it. We labeled that as a wave C, and it's declining now, as you can see. Getting sold with everything. Next. Chapter 71, here's a 2-hour view. Short term, there's the supply zone here. You might want to look for a possible reversal here. If you get a reversal, you could probably get a little bounce trade in this area with a tight stop. Next. Chapter 72, here's a bigger picture view of Tesla. Again, under a deep bear market, eventually could Tesla work way down into this range over time? I believe so. Next. Chapter 73, Google. It's been getting hammered during the bear market. Over time, this could be a target. Actually, that could be achieved fairly short term, 2150 to this area. If we get a washout, just in a few days, it could even get down to there perhaps. That's your next big demand zone. And this is a support as well. Next. Chapter 74, SJM. One of the members posted this, Morton. Pretty strong stock in this environment. Next. Chapter 75, BMY. It's coiling. This could go either way, up or down. An idea from Time Bandit. Again, I'm not going to throw a bunch of ideas here, guys. Like I said, in this type of environment, capital preservation is the key. And one last thing, when the market does form some sort of trade low, you'll get one of these rip your face off bear market rallies, and they could be quite extreme, and you could pretty much buy anything. So you don't really have to be that picky. Once we do get one of these rip your face off rallies, everything will go, and you want to keep your ideas to a minimum. And again, guys, just remember, long term, we're in a bear market. Capital preservation is the key. Keep your trades to a minimum. And don't overtrade, and that's it. Anyway, I've talked long enough. I did not mean this video to be 47 minutes. So we'll see what happens tomorrow. Sometimes Tuesdays, you get turnaround Tuesdays, and we'll see if that happens. Take care.